Welcome to the deep dive. You sent over this really interesting document today. It's excerpts from the Estonian Accounting Act.
That's right, straight from Rigi to Taja, their official gazette.
Now, I know accounting law might sound, well, a bit dry maybe,
Yeah, it can sound that way.
but this is actually the legal blueprint. It's what demands financial honesty across their whole economy.
Exactly. Forget the dense legal text for a second. What we want to do here is show you how this kind of detailed framework makes sure financial info is, reliable, consistent.
And comparable internationally, right? That seems key.
Crucially. So our mission today is to quickly unpack the Act's core ideas, show you just how wide its scope is, it's surprisingly broad, and reveal the intense detail it requires for just basic documents.
Consider it a quick masterclass in legally mandated financial transparency.
You got it.
And the scope, yeah, that's really the place to start. Because this net, it catches pretty much everyone. Section 2 defines these accounting entities.
And it is wide.
It's not just like every company registered in Estonia.
No, it's exhaustive. The state itself, the Republic of Estonia, is listed as an accounting entity.
The state, okay.
Yep, local governments too. All legal persons, whether they're public or private if they're registered there, even branches of foreign companies.
Wow.
Basically, if you're doing business financially in Estonia, you're probably covered by this.
But the thing that really jumped out at me was even the smallest operator, the individual
It's
entrepreneur,
for proprietor, yeah.
they're officially listed as an accounting entity. They have to organize their books under this major piece of law.
It really shows that transparency isn't seen as optional, regardless of your size.
Makes sense.
But yeah, with such a wide net, you absolutely need clear foundational rules, and that's what Chapter 1 gives us.
Okay, let's dive into those fundamentals. Section 3 lays out the basics. These are terms every finance pro knows, but the Act locks them down legally.
Precisely.
Yeah.
Can't build a house without the foundation, right? So first, financial position. Assets, liabilities, and owner's equity.
And owner's equity, or net assets as they call it, is just the difference. Assets minus liabilities. Simple enough.
Simple, but essential. Then you get the performance side. Income, expenses. And the result, profit or loss, which just income minus expenses for that period.
So we have to have those definitions absolutely clear before anything else happens.
Exactly. Set in stone.
Now, what I found fascinating here is how they bring in the global picture. It's not just one closed-off local system they're mandating. Section 17 actually recognizes two main accounting frameworks.
Yes, that's a really important feature. The baseline, you could say, is the accounting principles generally accepted in Estonia.
Right.
And those come from this act itself, but they're fleshed out by detailed guidelines from their Accounting Standards Board, the ASB.
Right.
And for state bodies, there are also specific general rules for state accounting.
But what if you're, say, an international company operating there, or a public one?
Then you can use, or sometimes you have to use, the internationally accepted principle.
Which includes things like IFRS.
Exactly. EU accounting directives, international financial reporting standards, IFRS, and for the public sector, IPSIS, the International Public Sector Accounting Standards.
So it's a dual system, kind of?
Yeah, it ensures their companies and even the government itself can be immediately understood and compared internationally. Very practical.
Okay, let's tackle this next big one. Accrual versus cash accounting. That's in Section 5. And the main rule is accrual basis, right?
Correct. Accrual is the default.
So just quickly for anyone listening, why is accrual the standard? Why is it generally seen as giving a more accurate picture?
Well, accrual is really the gold standard because it records things when they actually happen economically.
Not just when cash changes hands.
Exactly. You record revenue when you earn it, expenses when you incur them, regardless of when the money physically moves. It gives you a truer measure of performance for a specific time period.
Like your example, if you sell something in December but get paid in January.
That revenue belongs in December's results under accrual, gives a much clearer picture.
Okay, so if accrual is the rule for, well, almost everyone, what's the exception and why allow it?
Yes, the one key legal carve-out. It's mentioned in Section 43. It goes back to that smallest entity we talked about.
The sole proprietor again?
Sole proprietor. They are specifically allowed to use the simpler cash basis.
So they only record income when cash comes in and expenses when cash goes out.
That's it. And it seems like a very deliberate policy choice, Keep the highest standards for bigger, more complex entities.
But give a bit of a break, regulatory-wise, to the smallest businesses that maybe don't have, like, dedicated accounting staff.
Precisely. maximum rigor where needed, practical simplification where possible.
Okay, we've got the theory. Down accrual is king, mostly. Now, how does the law make sure that theory actually happens properly on the ground?
Right. That's where the discipline of documentation really kicks in. And this is where the Act gets quite prescriptive.
You're not kidding.
Chapter 2 lays out how accounts have to be organized, and it's all geared towards one main goal: providing information that is up-to-date, relevant, objective, and comparable.
And they list 4 pillars for organizing accounts.
Yeah, basically. Document every single transaction, record them properly in journals and ledgers, prepare the necessary reports, and this is crucial: preserve all that evidence.
And right at the heart of the recording part is the iron law, you could call it, of double entry bookkeeping. Section 6.
Can't escape it. Every transaction, same amount debited to one account, credited to another.
It's the internal check, isn't it?
It is. It's the self-balancing mechanism. Every complex financial system relies on that simple principle.
Yeah.
Follow the rule, and the whole thing has to balance.
Okay, now here's where I was genuinely a bit shocked reading Section 7. The level of detail required for a basic accounting source document like just an invoice or a receipt.
It's quite something, isn't it?
It's not just suggestions. This is mandatory legal info on every document backing up a transaction. Why demand things like the corresponding accounting entry number? What's the thinking there?
Traceability. Immediate, absolute traceability. Look at that list they mandate. Name or number, the doc, the date, the economic substance, what actually happened.
Right, not just stuff.
Exactly. Then the figures: quantity, price, total. Names and addresses of the parties involved, a certifying signature or signatures.
Okay, standard enough so far.
And that crucial accounting entry number. If you're an auditor, think about it. That level of detail required by law is fantastic.
Because the trail is right there.
Explicitly laid out, it connects the external piece of paper directly to the internal bookkeeping entry. No ambiguity.
That is thorough. Speaking of keeping a perfect trail, the rules on document preservation are also pretty strict. Section 12. 7 years seems to be the magic number.
But it is 7 years, starting from the end of the financial year that the document relates to.
For what kind of documents?
For the core stuff. Source documents, ledgers, journals, the final financial statements themselves, contracts, too.
7 years. I mean, I sometimes struggle to find receipts from last month. This is the state basically legislating financial memory.
Pretty much. And it gets longer for some things. If you have documents linked to long-term rights or obligations, think like a 20-year loan agreement or a long lease,
Okay.
those documents have to be kept for 7 years after their term of validity expires.
Wow. So if a lease ends in, say, 2040, you're keeping that paperwork safe until 2047.
That's the rule. And they've thought about digital records, too. The Act specifically says if you create journals and ledgers electronically,
Which most businesses do now.
right, they have to be preserved in that electronic format. And crucially, their legibility must be guaranteed for the entire retention period.
So no claiming the file got corrupted 6 years and 11 months down the line.
Nope. The responsibility is on you to ensure it stays readable for the full 7 years, or longer if needed.
All right, let's shift to the end product of all this. The annual report. Section 14 says it's 2 main parts, right? The annual accounts and the management report.
Correct. But the key underlying idea, the sort of philosophical mandate in Section 15, is that the annual accounts must give a true and fair view of the entity's financial position and performance.
True and fair view. That's the goal.
That's the ultimate obligation. And to achieve that, the law says the annual accounts must include those 4 main statements we all know:
The big 4. Balance sheet.
income statement, cash flow statement, and the statement of changes in owner's equity.
Okay, now Section 16. This is where it gets really interesting for me. The 10 basic principles that govern how you prepare those reports. These aren't just like best practices. They're legal requirements, philosophical ground rules.
Absolutely. And some of them are fundamental. Let's pick out a few key ones. You've got the going concern assumption.
Meaning you assume the business will just keep running indefinitely.
Pretty much, unless there's clear evidence it won't. Then there's materiality.
Which basically says, don't sweat the small stuff.
Sort of. Only information that's significant enough to potentially influence someone's decision needs to be fully disclosed according to all the complex rules. Immaterial items can be handled more simply, saves time and effort.
Okay. Then you have principles that seem designed to stop misleading reporting, like the matching principle.
Oh, absolutely essential. Expenses that relate to earning revenue in a specific period have to be deducted from that revenue in the same period.
Keeps the profit figure honest for that period.
Exactly. Then there's conservatism. Be prudent. Don't overestimate your assets or your income.
Sounds sensible.
It is, but, and this is fascinating, this act adds a specific prohibition. You are explicitly forbidden from intentionally understating assets or income, or from creating, and I quote, reserves hidden from the users of the statements.
Wait, so the law stops you from being too conservative? From deliberately making things look worse than they are?
Yes. It stops companies from sandbagging their results, creating secret rainy day funds hidden away from investors or lenders.
That's quite pointed.
It really is. It says, yes, be prudent, but don't actively deceive people by hiding value or creating hidden reserves. It's a direct hit against potential internal accounting games.
And another one that stands out, substance over form. Elevating the economic reality above maybe the strict legal structure. Why is that needed in law?
Well, because financial engineering can get very creative, right? This principle says you must record transactions based on their actual economic substance, their real impact, even if the legal documents are structured to look like something else.
Like trying to disguise debt as something else.
Exactly. Or maybe structuring a deal as a short-term sale just to temporarily pretty up the balance sheet. Substance over form says, nope, we look at what's really happening here. It forces transparency past the legal dressing.
So it's proactively shutting down potential loopholes. And to make sure everyone reports consistently, they've set up this annual report taxonomy, Section 141.
Yes, established by a government regulation. It standardizes the elements, the data structure, how things are tagged in the report. Think XBRL tags, essentially mandated.
Which makes digital analysis much easier, I imagine. A big step towards standardization.
Absolutely. And it ties back to that international alignment we talked about earlier. Because financial language needs to be global now, the law mandates that certain types of entities must use IFRS.
Which ones specifically?
Credit institutions, banks, insurers, and any company whose shares or bonds are traded on a regulated market. For them, using the IFRS framework approved by the EU isn't optional, it's mandatory under Section 17.
The stakes are just too high for them to use only a local standard, I guess.
Yeah.
Needs that global benchmark.
Precisely. International investors demand it.
Okay, this leads us nicely into oversight. We mentioned the Accounting Standards Board, the ASB, set up by the government, issues guidelines explaining the act.
Right, Section 32.
But the structure around its independence, that's the really striking part here, isn't it?
It's a remarkable choice structurally. While the Ministry of Finance handles the organizational side, the Act explicitly states that the ministry, the government, other state bodies, they shall not interfere with the content or the preparation process for the ASB's guidelines.
Wow. That's a strong statement of independence written right into the law.
It is. It effectively puts the technical accounting expertise of the ASB above potential political influence on the rules themselves.
So accountants set the accounting rules, not politicians looking for a particular economic result.
That seems to be the clear intent. And that independence gets another boost because draft guidelines must be published for public discussion for at least 2 months before the ASB can approve them.
Transparency in the rulemaking itself.
Exactly. Built right in.
Now, what about the government's own finances? How does the state handle its accounting?
Well, state accounting is organized by the Ministry of Finance, as you might expect. But Section 36 says it has to follow generally accepted principles and, notably, those international public sector accounting standards, IPSAS.
Ah, so just like the private sector often aligns with IFRS, the public sector aligns with IPSAS.
Correct. It means the state's own annual reports, which include a big consolidated report and another one tracking the state budget implementation, are prepared to an international standard.
Allowing for comparison and scrutiny against other governments globally.
That's the idea. Benchmarking becomes possible.
Okay, shifting back to the corporate side. Consolidation. Big topic for larger companies. The Act defines a consolidation group.
Yeah, Section 27, basically a parent company, the consolidating entity, that has dominant influence over another company, the consolidated entity.
And dominant influence usually means holding more than 50% of the voting rights, right?
Typically, yes. And the requirement is to combine their financials, present them as if they were one single economic entity.
Standard consolidation practice. Are there ways out? Exemptions.
There are, but they're quite specific. Section 29 outlines them. The main one is if your group is already included in a larger, audited, consolidated report prepared by another entity, especially one based in the EU, that covers at least 90% of the voting rights.
Okay, so if a bigger parent company is already doing the consolidation.
Right. Also, smaller groups whose combined numbers don't hit certain size thresholds might be exempt as long as they aren't, say, banks or insurance companies.
Got it. Limited exceptions. Finally, let's touch on public companies. Those trading on a stock exchange. They have extra recording duties, don't they?
Oh, definitely. Beyond the usual financials, their management report has to get into a lot more detail. Section 241 mentions things like share capital structure, any weird restrictions on transferring shares or voting rights.
Things investors would really want to know.
Absolutely. But even more significantly, Section 242 mandates a separate corporate governance report.
Okay, what does that involve?
It's not just vague statements. It has to reference the specific corporate governance code the company follows, explain how they comply, detail their management bodies, and critically describe their internal audit and risk management systems.
So it's a legal demand to show the plumbing, the controls around the money, right alongside the financial results themselves,
Perfectly put. It directly links the pure financial numbers to the quality and structure of the management and oversight producing those numbers.
which should make the financial data itself feel more trustworthy because you can see the framework behind it.
That's clearly the intention, exposing the governance structure to public view alongside the financials.
So wrapping this up, this deep dive really shows the Estonian Accounting Act isn't just, red tape. It's a serious, comprehensive legal foundation for financial integrity.
Absolutely. And it cleverly integrates global standards, IFRS for corporates, IPSAS for the state, with really rigorous local enforcement, down to details like demanding 7 years of readable electronic records.
It's a structural commitment to transparency, isn't it?
It really is. And we saw that fascinating tension. A strong central legal framework from the government and parliament, but it supports an independent accounting standards board.
Whose technical work is shielded from political meddling.
And whose draft rules have to face public discussion. That whole structure, that balance, it really signals how highly they value the integrity of financial information as an institution.
And that institutional value brings us to our final thought for you, the listener, to chew on. The Act forces public companies to issue a detailed corporate governance report right next to their audited accounts. This legal linkage, integrating financial reporting with governance reporting, is quite a powerful statement.
It is. So the question to consider is this. How might that mandated connection, where you can't easily separate the financial numbers from the governance structures producing them, influence international investment decisions? Especially when compared to places where that kind of governance transparency is maybe just voluntary or best practice, but not legally required alongside the financials.
What difference does that legal compulsion make? Something to think about next time you're looking at an annual report.
Definitely food for thought.
We hope this deep dive has given you a new perspective on the, dare I say, exciting world of accounting law. We'll see you next time.